all these analysts were on board, and they asked me, so Han, what is your tech tenant composition in your overall portfolio? I said, about 4%. You're missing out. Google, Facebook, everyone is increasing the space. So you really are missing out on the boom. Then fast forward to November. Then they asked me, hey Han, what is your tech tenant space? I said, well, it's the same, 4% as well. And they're like, oh, you're so lucky. They're now starting to reduce space and you're insulated from that. So this 4%, this 4% is good. We're happy with this, and it has maintained at this level throughout the last 2 years.
Welcome to the Financial Coconut Podcast, our special series called Be Retired in collaboration with REITired and SGX. Okay, so I'm your host, Reggie, aka your Chief Financial Coconut, and I'm joined with the famous REIT influencer, right? So you want to introduce yourself for everybody that don't know you?
Yeah, I'm Kenny Law, a REIT specialist and also SGX trainer.
You want to shout out for your platform?
Oh, my new platform is a REIT Savvy. If you are interested to really find out all the Singapore REIT, all the information there. And by the way, this interview will be on the REIT Savvy also. We'll be sharing.
Yes,
all right?
yes.
So you can check out REITsavvy.com, REITsavvy.com.
Okay, any more must send invoice already. Okay, but yeah, but for a start, okay, this is a special series we are doing, and we're very happy to be with OUE REIT manager. You want to introduce yourself?
Thank you, Reggie. Good morning, everyone. I'm Han Khim Siew, CEO of OUE REIT. We're one of the largest Singapore diversified REIT with 6.3 billion AUM, and we have 1,655 upscale hotel rooms and more than 2.2 million square feet of retail and commercial office space.
Are you really considered a diversified REIT? You sound quite concentrated in the grand scheme of REITs. You know what I mean?
We're concentrated in the right place, in Singapore.
Well, start throwing banana already.
92.5% in Singapore. So yeah, we are. We have 50% of our income is from commercial office, 34% from our 2 hotels, and 16% from our Mandarin Gallery and also our One Raffles Place retail mall.
Nice. Okay. But on some level, it is still a situation where most of your portfolio is coming from office REITs. Right, in that sense, right? That's what you're known for. I don't think everybody will know you own Mandarin Gallery, Hilton, some of these things. But everybody will know, OUE, I see this. Every morning I go to Raffles Place, I see this building. Right. So that's kind of what you're known for. But off camera, I know we were talking about, some of your evolution of your strategy, right? You think like office REITs, maybe you want to recycle some of these things, right? So maybe you want to give us some thoughts around this. Like, what is your plan with your office REITs? What do you plan to do?
So I think going forwards, office REITs or offices, you'll see a bifurcation in the office space, where if you have prime, grade A, well-located, green-rated buildings, these will command rents which will keep moving upwards. Whereas offices in not prime locations and not green-rated, you will see actually rents performance also come down.
Why?
So because labor market is very tight. Now, when we're recruiting, when a lot of our tenants are telling us they are recruiting, one of the key factors whether employee or potential employee decides to work there or not, apart from the company, is the location of the office. They want to be in the CBD because you're only coming to work 3 days, 4 days a week. So when you come to work, you want to maximize it. So you want to do your Pilates class, you want to have your drinks, you want to do your shopping, you want to do, and the best of these facilities are typically in the CBD. It's right in downtown or along Orchard Road. So that is where the young actually want to be. So that becomes a determining factor as well. Are you in a location where potential employees like to be? In the CBD, it's very well connected. We have the downtown line now right across the SGX, which is, our OUE downtown office is right next to the SGX building. So they can access our 3 office buildings by Raffles Place, by the downtown, by Shenton Way Station. So, accessibility is very important.
Actually, you had 2 buildings just right next to the SGX Center, right? One is the OUE Bayfront.
Yes.
The other one is the OUE Downtown. I think correct. Just a few steps away.
That's correct.
Right.
That's correct.
Yeah. No, but I just want to dig a little bit into that, right? Because what you're suggesting is the changing or the evolution of consumer behavior when it comes to them choosing a place to work, right? So that is your position that, because more and more people are looking at a lifestyle way of working. So the heart of town is important. Is that kind of what you're suggesting?
I do believe so. And, in Asia, I think most people are back at work, right? So at One Raffles Place Retail Mall, we tracked the footfall. In the first quarter, footfall was 98% of the pre-COVID 2019 number. So which basically means everyone is back at work. Sales on our basement floor has surpassed pre-COVID. Everyone is actually back at work in Singapore for us, in our view. So yes, there is a work from home, etc. And that trend will persist, but you're not looking at work from home basically 3 weeks a month. Here it's probably 1 day, maybe 2 days, So there's a blend. And I feel it's actually important. So everyone says, oh, we got through COVID and it worked perfectly fine. We could use, all the different Slack, Teams, Zoom, that all worked. But what people don't know or don't remember is you had actually worked with each other for 2 years, 3 years, 5 years, 10 years. So there was a lot of internal equity built up. So you knew each other. So there was a certain trust. So when I pick up the phone, I call Kenny or I call you. Well, we know each other. So you say, okay, yeah, that's fine. This works. But post-COVID, there was sort of a large reshuffle. A lot of people left their jobs, moved to new jobs. So at the new organizations now, people don't have that internal equity. You don't really know each other. And it's very difficult to actually build internal equity online. It's very challenging. You have to be there. There's the water cooler talk. You go eat your char kway teow for lunch. And you have a chat about your family or activities you like Kenny taking a break from his Sunday soccer games.
You do Sunday soccer game, eh?
Yeah, still doing.
Yes.
Oh, okay.
Every week. Full pitch. He does a full pitch.
Yeah, but I agree to Hans, you have been not working from office,
I
right?
never have an office. That's what to me it's quite interesting phenomenon.
I still prefer to really mingle with people because at the end of the day, we are still social animal. You don't want to face a computer every day. It's pretty tiring.
It is inconclusive to kind of see what's the future on. Will people all go back to work or, will people work from home? But I think from your view, you probably have a more, sense data because you're the landlord, right? You know who is renting and all that, right? So I'm also kind of curious, how is this like work from home thing changing your tenant suite, like your tenant pool? Are people, your major tenants, are they shrinking office sizes? Are they renting less so that you have to rent to more people? Are there these dynamics going on?
Is there any structural changes in the Singapore office space?
Yeah.
So I would say if you go back during 2021, 2022, a lot of right sizing took place. A lot of financial institutions, banks, they actually right sized.
Right sizing, so positive, huh?
So
actually,
it's a positive word.
So they changed. So they reduced the amount of space.
Yes.
And most of them planned for 60% work from office.
Yeah.
But what they did not anticipate was 60% was the weekly average. But normally what happens is Tuesday, Wednesday, Thursday, it's 100%. So you have seats for 6 out of 10 employees. But then what happens to the other 4 who come in? They don't have enough space. So what you need now is collaboration space. What you also need now is actually some financial institutions are looking to increase their footprint because people want to come back to work. So, and you can't stop them from not coming back to work on the Tuesday, Wednesday, Thursday. So anecdotally, there were many stories where all these bankers were struggling to get space and everyone got very frustrated. All the meeting rooms were taken because whoever could not find a cubicle or an office or the desk use the meeting room. So there was no meeting rooms and not enough office space.
Yeah.
So
maybe that's why your basement footfall increased. Everybody's working downstairs.
You're going downstairs.
Yes. We're happy. We're integrated.
But do you see your co-working space increasing in terms of trend?
No, I think co-working has probably stabilized. That there is a recognition that there's a space for co-working operators, but at the same time, there's also a space for traditional office occupiers as well who like that as well. So some would use a co-working space as flex space. Some would offer it because some of their staff would prefer the option of having co-working space. Some will be much smaller operations setting up and do not want to start up a whole new office space until they feel they've stabilized the business. So they'll say space. So it's a lot cheaper for them for a startup to be in a co-working space rather than sign up a 3-year lease.
Of course. But just to be clear, in other words, what you're painting for us is that your tenant mix hasn't really changed.
No, I mean there's obviously concern on the tech space, but our sort of floor plate of all 3 of our office buildings in Singapore are sort of not really catered for the large tech tenants which take 30,000, 40,000 floor plates. Most of ours are sort of 20,000 and slightly below that. So we have 5% tech tenants. So I remember when I had my first analyst call back in 2022. So early 2022. So all these analysts were on board, and they asked me, so Han, what is your tech tenant composition in your overall portfolio? I said, about 4%. You're missing out. Google, Facebook, everyone is increasing the space. So you really are missing out on the boom. Then fast forward to November. Then they asked me, hey Han, what is your tech tenant space? I said, well, it's the same, 4% as well. And they're like, oh, you're so lucky. They're now starting to reduce space and you're insulated from that. So this 4%. This 4% is good. We're happy with this, and it has maintained at this level throughout the last 2 years. Back during 2022 and early part of 2023, we saw a lot of North Asian companies actually establishing their second base in Asia or outside their home country, the Asia Pacific headquarters outside their home country in Singapore. Because Singapore government, had made it very easy for people to be working out of Singapore.
Okay.
So that's very positive, and it has stayed in that, in that format. And Singapore is a very neutral country in that sense. So there are some Taiwanese sort of financial institutions which are growing their footprint because their clients are telling them, look, we don't want our deposit and we don't want our money to be in Taiwan. We want it to be sitting in Singapore. Because of the geopolitical tension. So they're nervous, but not all of it. But they want some diversification. So Singapore, has offered that as a diversification because it's Mandarin is readily spoken in Singapore. Accessibility in and out of Singapore is easy. So that actually helps maintain the demand for office space in Singapore.
Fair.
Right?
Okay.
Actually, recently there's a Bloomberg article a few days ago. I believe that we have seen it. The Changi Business Park.
Yes.
The vacancy rate actually increased. They are start questioning the relevancy of all the office space. Does this news really affecting your portfolio on office space, and why not?
Yeah, if you think back probably 10 years ago, and this was a global sort of trend, where you live probably 2 hours away from office, and then everyone wanted a hub and spoke. So headquarters is 2 hours away. Then you wanted a spoke office, which was maybe half an hour away from your house. So then you can say, I go into headquarters 2-3 times a week. The rest of the time I go to this suburban office. So then that sort of worked back then because they were trying to cut down all the employees' travel time. Which if you're doing 2 hours each way, it's a very long day, right? So. But after COVID, most employers accepted it's okay. You don't need to go to the spoke office. You can just work from home. And when people wanted to go to office, why do you travel half an hour from your home? You might as well go all the way into the main office and see everyone because everyone's going into the main office. So this work from home phenomena, I think, has impacted this sort of spoke type office. And you see this phenomena happening in the US and in Australia. We saw that happening as well. We were there sort of in late 2022. So this phenomena I think will continue to persist.
Okay.
There's obviously for those these type of offices, they can change the use. They can think of other ways to capture new demand, right? But as is, I think it will struggle. So this comes back to the new people coming out to work. Do you want to come into CBD or do you want to go there? Because it's much more interesting to be here because everyone is in town.
On that front, you're painting quite a rosy picture for the CBD style office, top tier offices, prime location and all that, right? How are you going to optimize kind of your rent? Because as a landlord, you're trying to push rents, right? Pretty much, right? So what is that kind of process that you're thinking of? How do you value add, and what's the probability on that front? Okay.
So probably some sort of numbers.
Yeah.
So Grade A CBD office rents in the sort of first quarter was $11.95 per square foot per month. Our average passing rent, expiring rents for our portfolio in Singapore is $10.50. So when we renew, that positive increase, that positive rental reversion is in place for us to enjoy. Right, in the first quarter, our positive rental reversions, meaning the leases which had expired and renewed with the tenants staying there, the average was 12.6% increase. And because we're still so far below the spot rent, we still see opportunity for the rest of this year to also have rents start moving up from a much lower base. So you have to understand, a lot of leases which were signed in COVID, these were much lower rents. So that had all been adjusted downwards. So we're sort of moving up as somewhat normalizing, right? Plus, we were coming off a low base and we're not coming off a very high base and then trying to push it higher.
So on some level, you're quite happy with the lease expiry, so that you can.
Yes.
Because not all landlords, all REIT managers are, they always talk about, we got long lease and all that, right?
Yes.
But from your point of view, it looks like you're quite excited.
So we are. I would say we are lucky. We're lucky. We're in this cycle at this point in time with the expiries, right? So, I mean, longer leases does provide a certain stability, but. I think in an inflationary environment, which I believe we will be in for the next couple of years, inflation will be higher, I think, for the next 10 years than it was for the previous 10 years, right? For a variety of reasons. We can go into that. But what we like about our leases in Singapore is 3-year leases. So if inflation keeps picking up, then lease rents have to keep picking up as well. And the government's managing the supply very well in the CBD. There's a CBD incentive scheme, which in effect reduces the office supply. The government is not releasing any more government land sales within the CBD to build offices. So supply is very much capped until 2030. So as long as demand stays the same or demand increases a little bit and supply is the same, you have sort of, you have upwards pressure on rents.
So how much revenue is it coming out from these few properties that you have? Percentage of your overall?
So total office is 50%.
Okay, so that covers about more than half of your portfolio.
Yes,
Okay,
that's
okay,
correct.
fair.
How sticky is your tenant to stay with you? Right, because it's not like the US. Basically, I think the landlord, they have to take care of a lot of renovation costs and all those things, right? But in Singapore, what's so different compared to US commercial office? Because now people talk about commercial office, people really worry about the office space. They just run away. But I think the Singapore and also the overseas office, they are really, really distinct in terms of the commitment from the landlord to support a tenant. So maybe you can give some color on that side.
Okay, so coming back to sort of, the differences in office for the various regions, the US, Europe, Australia, Singapore. So a recent survey was done, a global survey was done on the amount of space used per employee, office space used per employee. Asia Pacific had the lowest, right? So meaning the amount of space that is being utilized is the lowest compared to the US, which was the highest. Which means the amount of right-sizing, downsizing, there comes a point where if it goes too small, you fall off the table because there's no more table. There's no more table for you to work on. So we are probably at that limit, right? So, and if employees are coming back to work, this is probably the limit as well. We're at this point where obviously there's, the Fed tonight will make a call on their dot plot strategy. Inflation is still high. There's a lot of geopolitical tensions. Business sentiment is, I would say, sort of cautious going forward. So for a tenant to move, they need to spend capital expenditure to fit out offices. So currently, the mood is, well, I think we should just stay put. If we need to, just do a slight touch up rather than spend $150, $250 per square foot. A touch up, maybe $30, $60 a square foot. That's good enough for the next 3 years. So it means for them to move to a new location, the rents have to be a lot lower to then justify that increase in capital expenditure for new fit out. Most tenants are really deciding just to stay where they are, unless there really is a push factor because there was a M&A, so 2 organizations need to combine to put in one space. Then otherwise there's very little push factor, right? The pull factor is unless sort of rents are being dropped at new buildings or other buildings, then there is a potential pull factor. But so landlords in Singapore, which currently have tenants in place and occupancy is higher. Average occupancy is 95% in the CBD. So it's a very good position to be in because tenants are currently very sticky. Now, obviously, if you move forward and business is booming and the outlook is, it's a completely blue sky, then that may change somewhat. But I think over the next few years with inflation being stickier, being higher than what it was, I think most businesses will approach with a more cautious strategy.
Commercial office, I believe that you feel very comfortable on your current portfolio, correct? So beside you want to increase the rent, hopefully moving forward, what are the strategy you want to capitalize the current opportunity? Do you see the competition from your neighbor competitor? Or are you planning to any new acquisition on the commercial office? Because everything seems very rosy now, right? Are you looking for some building here to acquire? Is SGX center
good
available
enough for you?
acquisition?
Yeah. Or do you want to acquire the spoke offices? I don't know what are your plans on the
No, for offices in Singapore, we like our composition at this point in time. We if we do look at offices, it has to be prime core location, right? And for us, ideally, it has to be brand new with the latest green rated credentials. Because we have made commitments on our ESG journey. We moved from reduction of emissions intensity earlier this year to absolute reduction. So absolute reduction is very different from reducing the intensity. Intensity means if currently we are reducing 30% intensity, if we buy another building which we can reduce 30%, then that means we hit our target. But what we're saying absolute now is this is the number. It's 100 today. If we buy another building and that building has extra emissions and we can't bring it down, let's say it's 20, then it becomes 120. Then we are actually moving further away from our target of reducing. So that building ideally is actually net carbon zero. Or we can actually do quite a bit of work to actually reduce the emissions on it.
Just to kind of dig a little bit, right? Because ESG sounds very sexy and all that, right? Everybody's talking about it. But from a shareholder standpoint, right? I only care about whether you can continue to optimize my yield.
Give me dividend.
Right? Give me because that is your role, right? Like that's what you're supposed to do in that sense. So help me understand, right? Where is this coming from? Does this ESG shift actually benefit me as a potential shareholder? How is that going to work?
Okay, there are a few angles to look at it.
Yeah, of course.
So very simply put first one is I don't do anything to the building. I don't need the green rated. I don't need to upgrade the chillers. I don't need to do anything. Okay. So what happens is you then run the building and then you'll start missing out on the multinational tenants, or you start missing out on tenants which have made commitments on the ESG front that they will be in a green rated building. So you start losing these tenants, which means the pool of potential tenant shrinks. So the long run impact of that, or even medium term impact of that, is your rents start coming down. So it will start coming down to a point where it's very it's very cheap, and you're not optimizing the location or the type of office building you have.
Okay.
And when you decide to sell it, a buyer will say, hey, for me to then actually bring up the building to the right standards where I can attract the whole market, I need to spend X amount. So, okay, you can sell it to me for this current low price which you are trading at because your rents are so low. Plus, I want to deduct X amount because this was the capex you should have spent, but you did not spend. So your value has dropped.
Okay. Fair.
So capex is needed to maintain these ESG credentials, because that is basically future-proofing your investment.
Yeah. I get it. So fundamentally, it is because the MNCs have certain commitments, and then they come to you as the landlord. They're like, okay, you must meet these commitments, then we will work with you.
So that's from the physical part, the physical, building part of it. The other part of it is a lot of banks, financial institutions, investors have committed on their ESG journey as well.
Okay.
So the green wallet, which essentially means financing available from banks, from bond investors for green type buildings, or converting or making a building green rated or improving the green credentials, it has increased significantly over the past 5 years, and it will continue to do so. So your access to financing is also wider if you are committed to that green rated building, your ESG journey. Plus, we've done quite a few sustainability linked loans where if we hit our targets, there's a reduction in the cost of interest as well. So interest rates do come down for us. We recently launched our green bond last week, and the demand from institutional investors was really strong because it was a green bond.
Okay. How much discount can I get from this kind of green financing?
Well, it's a journey.
Yeah.
And unfortunately, we have an NDA which we can't share with you.
Yeah. Is there a general variance that in the market you can observe?
A lot of banks have committed to it. Right? So it is, it's not significant in the sense that it will significantly impact the dividends.
Yeah.
But it is a step in the right direction.
Okay. Then I also want to ask, right, how much capex do you need to then invest going forward? because you're trying to shift your portfolio to be greener and greener, right? So we're expecting a general capex bump and a sustained.
We do that on an annual basis.
Okay.
So, and obviously, when BCA increases their requirements, then we will then need to recalculate how much more we'll need to spend in terms of capex to maintain our current green mark rating.
I think this ESG also has some relationship to your credit rating. There are some linkage, right? Maybe you just can elaborate to let the audience know that what would be the linkage. Because when you are meeting certain ESG target, definitely there are some of the gearing ratio may come down, then also affect your credit rating, right? S&P or Fitch or Moody's. And overall, basically you reduce the cost of borrowing. At the end of the day, maybe can increase the dividend for the investor. So help us to link up all these kind of little dots.
Okay.
How ESG can benefit the investor.
So green rated buildings, so let's say the ratings agency, obviously, they allocate certain sort of points to, if you're in a sort of prime location, you get highest points. If you're in key gateway cities like Singapore, you're on the you're rated at A. Right, so prime location A. So green rated, if you're in the top tier, then you get an A. So there are a wide number of categories, and it all contributes to this to the ratings, right? So it's a lot of criteria, but green rated, yes. Prime grade A office building location, yes. Country. If there's very little risk, then you get an A, right? So that's why it's very important for us to focus on certain locations, certain countries. Why it's important for us to maintain our green credentials, because then that translates into basically the net property income for the various assets as well we have in Singapore. So you actually sort of performing better. So then yes, that gets another A instead of a E.
And Singaporean always aiming for the A,
So we try, we're OUE REIT, but we try to be OUE REIT A.
Yeah. So you mentioned that actually OUE REIT, you have a portfolio mainly focused in Singapore. It's so-called diversified portfolio.
Yes.
But somehow it's diversified. You have a diversification to maybe China. You have one Lippo Plaza in China, and revenue contribution or income contribution is pretty low compared to your total portfolio. But you also need to spend time to really manage your portfolio. You also need to travel to Shanghai to really visit your property, not for the Singapore mouse, okay? SIM mouse, all right? So why do you want to keep this Lippo Plaza? Do we have any plans to really recycle your capital to really do more acquisition to other sector to further diversify our portfolio?
So our Shanghai asset was a seed asset when the REIT was first listed in 2014, together with OUE Bayfront. So it has been there since then. Now during that period, until 2022, performance actually kept moving up, right? So it's on middle Huaihai Road. It is basically 2-minute walk to Sing Tian Ti. So location is prime, right opposite us is the Hermes flagship store for Shanghai. So so undeniable location. 2/3 of it is office, 1/3 is retail. Okay, so that is what the asset is. But it's a very prime core asset. So the stress has only come in the last 2 years, right? There are a lot of oversupply in Shanghai, and I think you'll still see that stress for the next 12-18 months. But we do believe with the prime location and core location, it's very defensive still. Tenants still want to be there. So our office occupancy has dropped to 75%, but our retail occupancy is still 95%. Why? Because these tenants understand this is a very prime, very core location. So what we're trying to do there is we're just trying to be a little bit more flexible with regards to our leases and have the building occupied in the meantime. So it's sort of having to work through this structural overhang from a lot of oversupply in the office segment in Shanghai. But again, we do believe, it's coming back to our story on office. People want to be in Shanghai. And they want to be in Puxi, and they want to be on Middle Huahai Road or Lujiazui Road. So the better locations, they want to be there. So we do believe that actually quality will still stand out eventually. So now it's just riding through that period, and revenue from our Shanghai asset is 7.5%. So even if tomorrow we say, okay, rents are all cut 30%, it all drops, meaning all the tenants, the impact is 2.4% on our total portfolio, which, okay, there's a drag, but it really doesn't sort of impact our overall momentum going forwards.
Okay. So from what I'm hearing, you have no interest in divesting from that property. You still believe in the long-term story there. And there looks like there's an opportunity in the market because the whole area is oversupply. Then why not you double down?
So, when I talk to the Shanghainese, they say, they all want to be in Puxi. And these are the various locations that they do want to be in. And they say whoever chooses the other locations are really not Shanghainese, and they really don't understand the Shanghai market. On the question of divestment, obviously if the right sort of opportunity comes along that we recycle capital, we will take a close look at it for sure, right? And if we believe there's an opportunity to redeploy and improve our dividend yield, yes, I mean, I think that's a financial obligation we have to all our unit holders or shareholders and stakeholders that we have to consider it very carefully. Right?
Okay.
But it's a bit like selling something on Orchard Road.
A bit sian, huh?
It's a bit, it's like,
okay.
It's very hard. It's irreplaceable
Yeah.
location-wise.
But come back to your acquisition on the commercial office. Which region that you're currently looking at? Or is China or Shanghai? Is just like you mentioned, you like Puxi a lot and those things, right? Do you think that if you really want to acquire, are you looking to acquire any building, commercial office building in Shanghai, maybe Hong Kong area, or you look for other country?
If we go back to the ratings criteria, so key gateway cities important. So we are looking at obviously for now Tokyo, Sydney, Melbourne, Hong Kong. China with a large oversupply, we're probably doubling down when you're trying to average down doesn't really work in a office sort of context. Averaging down in a stock which is taking a hit from a macro event, that probably makes sense.
But can you help me understand a little bit? What does it mean by averaging down the office doesn't make sense?
So you can buy let's say an office building now, in
what is
a more decentralized location, probably 30% lower. Right. So which means your average cost has come down, your overall yield has gone up. From China. But that's a structural overhang, and the right thing in the immediate term and the short term will actually be to for our next acquisition, next investment will be not in China, but it'll be whether it's Singapore, Hong Kong, Tokyo, or Sydney, Melbourne. Then that actually is for us a lot more interesting. Hong Kong actually is quite interesting because there's been a lot of repricing in terms of value, and we're starting to see a lot of value coming through from hotels, from office sector.
Hotel is 1/3 pricing going, right? Everything is down.
So it's so we think that's really interesting, and I worked in Hong Kong for 5 years. I really like it. I think there's a certain buzz about it. Hong Kong going forwards will probably be a little bit different from the previous Hong Kong, but Hong Kong has always been able to reinvent itself. So I don't see why it will not be able to do so.
Okay.
Do you foresee the next 1 or 2 years, you will see the pocket of opportunity for all the commercial office transaction? Because we are more or less at the sweet spots now, all right? The valuation of the commercial office or even some of the hotel become attractive, and interest rate maybe start to coming down by end of the year. Do you see that your OUE REIT will be actively going for acquisition for this 1 or 2 years?
I would say, look, we're starting to go into a phase where values are starting to make a lot of sense, right? So whether that is in office space, that is in hotels, but we've actually committed. We believe our strategy is to move from 34% revenue from our hospitality segment to 40%. Now, part of that will come from the inherent growth from our 2 hotels, right? So visitor arrivals last year was 13.6 million. 2019 number was 19 million. This year, 16 million. If we get 16 million this year and we keep the same room rates, occupancy will move up. And if next year it goes back to 19 million, occupancy will move up, which means our overall revenue per available room, the RevPAR, will continue moving up. So the 2 hotels, the Crowne Plaza Shanghai Airport, Hilton Singapore Orchard, we see that contribution growing, but I don't think we'll get to that 40%. That 40% means we do need to acquire, right? So Personally, I really do like the hospitality segment going forward because of inflation. Why it's good? So you get dynamic pricing in a hotel, which means you can adjust your room rates up and down every day. So if we think inflation is moving up, your chicken rice is moving up, so is your hotel room rate moving up, right? So you can adjust it. Whereas leases, so commercial leases, you're locked in for 3 years. Then the cycle's a bit slower, but it's a lot more stable, right? So also traditionally or historically, cap rates for hotels have been a bit higher, right? They are trading sort of 4.5 to let's say 7.5%. Offices are pretty tight. They're like 3.5 to 5%. So if we think inflation's higher, interest rates will be higher. So yield accretive acquisitions will be easier logically in the hotel space. We have the largest Hilton in Asia Pacific. It is the Hilton flagship hotel for Asia Pacific. So we have a 575 rooms in Crown Plaza, Changi Airport. So we have a lot of experience managing large hotels, managing a lot of rooms. So why not leverage off this in other cities as well? Essentially,
what I'm hearing is you're going to focus your acquisition in the hospitality space, right? So maybe you can share with us a little bit more. What's that thought process? What are you looking at and all that jazz?
So again, the theme through our REIT is we're very prime core assets. When you look at it, like you mentioned, the 3 office buildings with OUE on it, right? The Hilton Singapore Orchard is very obvious. Apple Store right across us. The Crown Plaza Changi Airport, if you arrive in Terminal 3, exit departure, turn left, it's a 150-meter walk and you're actually in the lobby itself, right? So even our Shanghai assets, very prime location. So we want to keep to this theme, right? This is what we're looking for. We're looking for very prime core locations. Now, the reason behind it is we actually have a gamma strategy. So which essentially means we benefit from volatility. There's 2 ways of looking at volatility. Volatility is very bad. Or how can we make volatility our friend, right? So prime core assets means we're able to benefit from volatility. Whenever there's stress in the market, whatever the market is, the equity market, the fixed income market, the watch market, the car market, there's always a flight to quality. It's the same for real estate. There's always a flight to quality. During times of stress, what trades is only your prime high quality assets. Very, very core assets will trade. Even at the worst of time, they will trade. So now, during the COVID period, we saw there was a flight to quality. So our 3 Grade A office buildings benefited from tenants who were willing to move up from poorer or lower grade office buildings to our buildings. And as we came out of COVID, all the tenants wanted to take office space. Where did they go first? They went to the best and high quality office building. So rents were then able to move up. We were able to move it up a lot faster because the demand was stronger than the supply.
But just now you mentioned that actually you want to increase your exposure to the hospitality sector. But actually hospitality sector is a double-edged sword, because you have a lot of DPO volatility in that sense. Do you have any plan to have exposure in the hospitality sector? At the same time, you have more predictable that kind of income, for example, service apartment.
I would not say no, but we do like that volatility, because if it's in very prime locations, core locations, we do believe we will benefit from that volatility as opposed to having to lower the.
But on the other hand, touch wood, touch everything. Another COVID, don't know what strike. Then you hit you badly, right?
But we got through it. We got through COVID. So I think with the hospitality sector got through the Black Swan event. And if you think back, room rates have moved up significantly. Our RevPAR back in 2019 was sort of 210. Today, our RevPAR in first quarter was 280. So it has moved up. Room rates have moved up. So everything has moved up. And this is post-COVID, post your worst Black Swan event, and has actually come out really strongly. So I would say, look, the hotel industry has adjusted. Yes, there's slight risk. That's why we like our stable 50% income from our office segment, and also probably 10% from the retail component, right? So it provides a balance that we are not betting all our horses on one asset class, but what we're trying to do is provide stable income in one part of the barbell, and then the other part with the retail, the hospitality, is trying to capture that growth from visitor arrivals, trying to capture overall macro trends, right? If we look at macro trends, Asia is actually, wealth is increasing. Globally, wealth is increasing. So more and more people are moving into that middle class segment. Once you have enough food in your stomach, you have a roof over your head, what do? You travel, right? You travel. And we believe travel industry will continue to accelerate, actually, because people are actually, overall wealth is improving.
But I want to understand a little bit more about how you kind of push your RevPAR, right? Because you said that from 2.1 to 2.8, right? That's your RevPAR for your hospitality, right? So was that a general market kind of movement and you benefited from that raise, or were you optimizing on the operational level? Like, what were you all kind of doing on the front?
So it was sort of twofold. One, obviously, overall improved visitor arrivals came through, and that pushed room rates up. And during COVID, a lot of landlords, hotel landlords or hotel owners realized you could cut your rent to $50, but if there's no one coming to stay, it's still vacant, right? You still can't fill it up. And as we were coming out of COVID, there was a lot of inflation, so wages went up a lot. So your operational expenditure went up. CapEx also went up. So higher room rates were actually needed to basically absorb the higher wages, the higher CapEx. So structurally, it has moved up. And landlords or owners of hotels realize, like I said, you can cut it as much as you want, but if there are no guests, there are no guests. So there's not much point in doing that. But it's more important to be more commercially, sort of to take a longer term commercial view, right? You can actually fill up your rooms at much lower rates. But what happens is, instead of a normal cycle of a light refresh every 7 years for your rooms, because there's a lot of wear and tear, it means it's probably 5 years. So you've accelerated that room sort of touch up.
Okay.
So by 2 years or so, or it was very heavily used, probably 3 years. So you then need to balance. Do you need 100% occupancy all the time with very low rates, or are you okay with a 70% occupancy with much higher room rates, and you don't have 6 people staying in a room, you actually have 1 or 2 persons staying in the room, and a lot less wear and tear in the room. Right?
Do 6 people stay in Hilton in one room?
There's it depends on the type of guest you get. There are people who squeeze a lot in the rooms, but look, so that's sort of one. Structurally, I think hotel owners realize room rates have to be higher. But also in our case, we did a very large asset enhancement initiative. So of $150 million, we started in March 2020. We completed our first tower in the Hilton and opened in February 2022. And then we opened the second tower in January 2023. So we then rebranded from the old Mandarin Orchard Singapore to the Hilton Singapore Orchard. So then that shifted the guest profile. So because 1,080 rooms is a lot of rooms to fill. So the strategy in the past was to take air crew, it was to take large low-cost tour groups. So the wear and tear was higher and rates were much lower. But we've essentially, said no to the air crew now, and we don't take in large low-cost tour groups anymore. So in the past, the hotel would be quite busy during peak holiday seasons, and then your earnings are lumpy throughout the year. So peak holiday season, great, full, great rates. Outside of that, fill it up with air crew, fill it up with large low-cost tour groups, which meant it dragged the overall average daily rate down for the yearly average. So when we replace it with the Hilton, we're tapping onto Hilton. They have a very strong corporate membership program, over 100 million members. So they have with that very strong corporate membership program, we're seeing an increase in corporate travelers. We're also seeing a strong increase in our North American geo-source guests. So it was 18%, it has now doubled. And when you have corporate travelers, they will normally eat in the hotel, have breakfast there, have meetings in the hotel lobby, restaurant, coffee shop. They will do room service when they need to do conference calls at night to the US or to Europe. So on a per person spend, it actually goes up, and the wear and tear goes down. Right? So we've shifted that across, and now we are able to structurally move our average daily rates up from where it was previously. And with the sort of refurbishment that we've put in place, a lot of the guests, especially from the US, say, "What? This is a Hilton? This is not Hilton. This looks like a 5-star Hilton." So we're providing like a 5-star Hilton with a 6-star location. So hence we're able to charge a lot higher than a typical Hilton charges globally.
Okay.
How strong is a seasonality based on the Hilton profile itself? Because hospitality sector normally is very seasonal based when it comes to the DPO distribution. So with all this kind of one-stop 6-star solution, so how volatile now?
So my math is not very good. So when I do 5-star sort of a Hilton plus 6-star location, it becomes 7-star.
No.
Is seasonality a concern now? Big concern
So we also rebranded and we try to manage that seasonality, right? So the hotel is still very popular with our regional guests during the peak holiday seasons. It was just the off-peak holiday season which was a concern. But when it's peak holiday season, corporate travelers don't travel. They travel during the off-peak holiday season. So that's the typical time that they travel, when the kids are not on holiday, the children are in school. So we're able to fill that and have a much smoother revenue sort of stream coming throughout the whole year by doing that.
Yeah.
So Singapore obviously had, the government STB has done a great job. First quarter concerts were incredible. Second quarter was a little bit slower, but with the 30-day free visa on arrival for the Chinese tourists, that really sort of we saw a strong pickup. I saw the number yesterday. It was Chinese arrivals year on year for month of May had picked up 132%.
Wow.
So so we're seeing the Chinese tourists come through as well. So they were largely absent in 2022.
Yeah, fair.
Right?
So are you a Swiftie?
Actually, I want to ask that question also.
Are you a Swiftie?
No, I can't quite say I'm a Swiftie. More of a Coldplay Bruno Mars.
Okay. So concert ticket cheaper for you, Okay, but I mean I understand what you're trying to do, but I want to kind of dig a little bit deeper into your choice of brand, right? Because within the Hilton group, there's many other brands, and then there are many other groups that you can not say many, probably 2 or 3 of groups that are at that size, right? Why this brand? Why this group? What are you looking at? And within this model, how are you thinking about this?
Right. So no, Hilton is a very strong brand for corporate travel, and the solution we needed was corporate travel, right? How do we fill up that off-peak season with corporate travel? So Hilton is very, very strong, especially in North America. So so that was one of the big considerations there. And we're able to be the flagship hotel for Asia Pacific, which means a lot of R&D for Asia Pacific takes place in our Hilton Singapore Orchard. So we're able to leverage benefit of that, a lot of that R&D that takes place as well. And also, we're the only Hilton in Singapore. They're not, you don't have 3-4 Hiltons. So again, limited supply of Hiltons in Singapore. So that means, that's a positive as well, which means Hilton corporate members come, your choices are you stay at the Hilton or the Conrad or the Waldorf Astoria. So there's no Waldorf Astoria, there's a Conrad and there's the Hilton. So the choices are, a lot of corporate travelers stay in the Hilton.
Fair.
So then we're able to benefit from that.
Who are you targeting for your Crown Plaza at Changi?
Crown Plaza at Changi,
it's
a real mix. It's a real mix, actually. I think IG will get quite nervous after you say that.
Hey, cannot like that. What's that called?
It's not for staycation. Right? We don't staycation over there. Who are you targeting?
Actually, staycation is super popular.
Really?
Right?
Yes,
Plaza?
super popular.
People do staycation at Crown Plaza.
You will be very,
comment section below.
very surprised. We have runway view rooms, so it's full floor to ceiling, and you don't hear the planes land and you don't hear the planes take off, except for the 747s. That's it. And a lot of parents take their children there. When your kid is 3, 4, 5, 6, 7 years old, you can see planes take off, land all day long. They are very popular for staycation.
And nobody write about it. I think this one can be the interesting thing. You just sleep in the room the whole day, looking at plane take off, landing.
You would be really surprised. It's
I am surprised.
super popular. We'll arrange one. We'll take you there.
Okay.
We have a new Italian restaurant which we set up, but that we can have lunch there. But sit there for 30 minutes and tell me how many planes you can see.
Hey, can we take some video and also
Yeah,
put
for
on
sure.
TikTok? We just want to see a room.
For sure. It is actually super popular. So that's that's a significant portion of our guests is actually staycationers. Really. So
voice already, additional business opportunity.
Interesting. Yeah. So, okay, wait, but with that suite, right? Essentially, even in your hospitality vertical that you want to pump up more, there's also kind of like a mix of audience, right? Like maybe in your commercial, it's a little more concentrated. Your target pool is quite standard, but in your hospitality sounds quite dynamic. There's a corporate traveler, and then there's the staycation Crown Plaza people. Shout out to you. What is your how are you going to optimize this?
For the Crown Plaza, we Singapore is a very popular stop. It's for the kangaroo hop, they call it. So travelers were coming from Europe, US, going to Australia. So if you've been on a plane for 10, 12, 15, 16 hours, you need a break.
Yeah.
And a lot of travelers stop in Singapore and then they take a break, and they, the layover can be half a day, 8 hours a day. And we actually get a lot of guests who stay at our hotel and they specifically choose the pool floor. So they can swim, sit under the sun and just relax.
They don't need the plane because they just hop off it, right?
Yes. So we in our refurbishment we added on 12 more rooms on that full floor. So we took away the business center, the gym, we moved it to other floors because the demand was really strong for that type of category. So that's really popular. We also have slightly longer stay guests. These are the consultants working on Terminal 5. So the Crown Plaza is the only international branded hotel in the whole Changi area. So they stay there. Aircrew naturally is one of one of our large geo-source guests as well, because it's right next to the airport. So you don't run the risk of traffic jam, anything happen to a bus or a coach or a car breakdown. So
aircrew cannot stay at Hilton, but can stay at Crown Plaza.
It's convenient for them. It's convenient for them, right?
Fair. No, but I want to understand. So based on your room mix, right? Like how are you going to expand further? What are we looking at? Because you do say that acquisition has to come in to kind of push your portfolio to that 40, percent, from hospitality, right? So you have a little mix of different kind of participants in your hospitality space. Right. Where are you going to focus on to double down?
Again, it's very much we like cities which are have a lot of tourists coming through. And also which have business travelers coming through.
Okay, so something like
let's say Tokyo, Sydney. It's very popular for tourists. It's also very popular for business travelers. So we're able to again even out that seasonality, right? That's our experience from the Hilton. So we like that. We like that profile. So it can be business travelers, it can be tourists coming to stay. So we're not, we're reducing that lumpiness. And coming back to what Kenny said, we can then provide that sustainable dividend yield and that growth coming through as well.
So you're more trying to create another Hilton Singapore rather than Crown Plaza, something like that.
We just like the prime core location. On the Crown Plaza, OUE Limited, a parent group holding, they've just won a tender for another hotel, a 250 room key hotel, on top of the Coach Bay in Terminal 2. So we have a right of first refusal on all our sponsor assets, right? So this one will be probably completed in 4 years from now. So, that's a potential addition to...
Ambiguous, but not ambiguous. But interesting.
We haven't committed to anything.
I get it. But you have the first right.
I cannot commit I cannot commit the REIT's hand because if we negotiate on pricing, if I say, hey, on Reggie show, you said you'll buy it. So our negotiations we've given our hand away.
I hear you. Interesting.
How big is your RevPAR jump on the Taylor Swift concert?
Taylor Swift.
Because I think we cannot ignore the Swift nomics.
Taylor
Swift nomics. I don't know what I call it, right?
It's like a boomer trying to talk about it.
It's a mega all the mega concert. Actually, they are in a few gateway city. right? So if the impact of all this kind of concert, you told me Jay Chou is coming to Singapore, right? End of the year, right? Do you see a big jump, a significant jump in terms of RevPAR?
So we saw a lot of concerts come through in the first quarter of this year. I have to say, Swissnomics, it really is real. You know, we saw in our 2 hotels, basically the business on the books, essentially the bookings, for that Taylor Swift period, 6 months out, it was already 30%. So 30% of our rooms was booked 6 months out. And this was specifically for Taylor Swift, period. Full stop. After, 2 days after she leaves, it falls. It clearly, and that's, I would say she's the only one of the concert sort of performers which has been able to do that. The rest, it picks up a lot closer to the event. Hers was 6 months out, actually. Hers is very similar to F1, right? The impact. In terms of pickup, I would say probably anywhere between, different days were sort of different pickup in the RevPAR, probably 25 to 40%.
So Tete works, huh?
It does. Significant. I mean, it was.
I cannot believe we're talking about
it was.
I cannot believe.
Yeah, it was noticeable. I mean, if you ask various hotels all across Singapore, they would tell you it's real, and it's. Yeah. We wish we could have Taylor Swift every year.
Yeah. Tete will contribute to your retirement plan, okay? Yeah. Great. I hear a lot of things that you're trying to do here, right? Expand this, do that, a lot of good stuff. And from that point of view, how do you plan to finance your strategy, right? Because there's probably some sort of capital recycling that has to happen.
Yes. There's
probably some sort of, maybe, I don't know, are you releasing new units, and all that. So how are you thinking of financing your strategy for the next 5-10 years?
So currently, equity fundraisers, so issuing new shares, that doesn't make. We're trading price book below 0.5. Yep. So it means it's very dilutive. It's not possible to acquire any asset which is accretive if we do an equity fundraise. So rule that out. So that means, and REITs are very, very regulated, very structured instrument. So for us, we try and keep our borrowing ratio, our leverage ratio below or at 40% or below. Right, that's a level which we're comfortable in. We're circa sort of 38. So there's not a lot of headroom. We can't borrow. We can't tap on a lot more debt to acquire an asset. Okay, so which means we'll have to look at assets which we believe are we can do. We've done the max we can do for these assets and recycle part of them or all of them and move them into assets which we feel able to provide us that yield growth, has value, and will do better over the next 5 years, 10 years than the assets that we are recycling out of. I mean, we did that for OUE Bayfront back in 2021. Proceeds, a lot of it we used to reduce our debt, pay down a lot of the debt, so reduce the overall gearing ratio, make the whole capital structure of the REIT a lot stronger. So it doesn't mean that we need to sell all 100% of it. We do like all our assets. So it may be a case of where we divest only 50% of it and then basically use it to acquire other assets.
Then why should people invest in OUE REIT?
This is your 3-minute plug.
You. So what we're focused on for the rest of this year is, in the office space, we believe there's positive rental reversion. Rents will increase, so income from the office will grow. With improved visitor arrivals, our 2 hotels will continue to grow revenue. Also, Mandarin Gallery revenue will continue to grow. So we believe overall on the revenue front, we were able to push it up. We've been actively managing our capital structure with various sustainability-linked loans, with the latest green bond, which was heavily oversubscribed. We're able to manage the cost of debt and keep it reasonably under control. Look, we're looking constantly at opportunities in Sydney, Hong Kong, Tokyo, Singapore, and seeing what else we can do to grow the REIT. So I think we're well set for 2024.
So be retired with the OUE REIT for the next 20 years?
Yes, for sure. Prime, there's always a flight to quality, Kenny. Prime core assets.
Good. Thank you, Han.
Great, and that's a wrap.
That's a wrap.